good morning. Welcome to the Retiree Benefit Trust OPEB Committee meeting for Friday, October 25th, 2024. My name is David Yingling, and I am sitting in for Mr. Weiskopf. We'll start off with a roll call. We'll start on the far right of the dais with our recorder, Ms. DeJournette.
I'm Dana DiGregorio. I'm the administrative recorder.
Joy Sapp, Plan Administrator.
Scott Ostro, County Commissioner.
David Yingling, Deputy County Administrator.
John Walters, Citizen Representative.
Vanetta Van Cleve, County CFO.
Great. And we'll start off with the approval of the October 25th, 2024 agenda with one minor change that I'm sitting in for Mr. Weiskopf. Can I have a motion?
Move to approve with one minor change.
Second.
All in favor?
Aye.
Opposed? Motion carries. And if we can get a motion for the approval of the August 23rd, 2024 meeting minutes.
So moved.
Second?
Second.
Okay, all in favor?
Aye.
Opposed?
Abstain.
Okay, thank you. That motion carries. And then we will jump right into the presentation from Marquette Associates, Mr. Patrick Wing.
Thank you, Mr. Yingling. Good morning again, everyone.
Morning.
So we have a little bit lengthier agenda than this morning, or earlier this morning, excuse me. But we'll start out as we did earlier. If you want to jump to page 4 here with a quick performance snapshot of Q3 again. We will have the full book when we meet again in December and dive into a little bit more granularity, but wanted to give you a snapshot of what took place in Q3. So as we did before, if you start on page 4, look up top in the summary of cash flows, you can see that we began the quarter or the fiscal year at about $120.8 million. You see the net cash flow, negative $1.2 million. The vast majority of that was for the county reimbursement, in addition to some marginal fees and expenses. But as you know, with this trust every quarter, and we'll do this in December, we make a recommendation from where to pull the assets for each quarterly reimbursement. So that'll be something we'll tackle in early December at our next meeting. All that said, the net investment change markets were pretty strong. So that change was about $5.25 million. So essentially when we sum up that negative cash flow plus the net investment change, the trust grew by about a little over $4 million during the quarter. Now, if you look at the performance summary in the middle of the page there, just really focus on the Q3 number. You can see the trust was up 4.4% during the quarter, about 20 basis points behind the policy index. We'll dig into some of those drivers here shortly. Number one, just for a little clarity, obviously a little lower than our meeting earlier because a lot of the private markets, we have 20+% in private markets, and those investments are carried at zero right now because we don't have the data. We'll get that data in the coming months for Q3. I'll share the Q2 data here in a couple of minutes. Slight driver of the underperformance was also the private markets being a little overweight, right? So if you have an environment of equities and fixed income that are gaining ground and you're carrying investments at zero, obviously that's below the investments that you have elsewhere. So a little bit of a drag from an asset allocation perspective. But we'll talk a little bit more about the relative performance in just a minute. As always, at the bottom of that page, we'll give you an up-to-date snapshot on the asset allocation here shortly when we talk about the recommendations, but always important to note, all the way to that right-hand column, everything is within its permissible board-approved range in the IPS, so we're yes up and down and green across the board. If you go to page 5, again, talk a little bit about the activity that took place during the quarter. Up top, in that net cash flow, you'll see some negative numbers for U.S. equity investments up there. If you recall, it was a fairly strong quarter, so we had made recommendations and the board approved to trim some equities as they were rising to really fill that cash bucket for those quarterly reimbursements, right? Those reimbursements running at kind of $1.2, $1.3 million a quarter. When you look at a sort of a 12-month span, that's a decent amount of the overall principal of the trust. So the key environment to really generate the cash that we're eventually going to need is when things are gaining ground, as opposed to the opposite when you're realizing losses to generate cash. That's sort of a worst case scenario. A little further down that column, you can see there was one key change amongst the Equity managers, you can see Invesco there was liquidated after we had presented a search for the board, and those assets moved to DFA. So you can see that negative 2156 or so. The vast majority of that moved to DFA, so that was executed during the quarter. And then any other non-zero number you see below that are either capital calls or distributions from the private market. So if it's positive, it was a capital call coming out of cash going to the manager, and vice versa for negative. So you can see the vast majority are negative. If we summed up all those numbers, in addition, if you flip to page 6, the first, we'll call it 1, 2, 3, 5 non-zero numbers that comprise most of the remainder of that column, we got back in aggregate about $660,000 from the private market investments, which is great. Like we talked about before, there's still a lot allocated to those asset classes, but they are maturing, meaning that we're getting back much more money than is going in, and in turn is going to be helpful with the reimbursements, right? So it's just less money that we have to raise, the more money we get back from the private markets. And at 660, that's basically half a quarter of a reimbursement. So it's helpful from that perspective. And then as far as the remaining numbers towards the bottom of that page, there was just some rebalancing, mainly within fixed income, adding about $500,000 to TIPS, that TIPS fund, and then rebalancing within fixed income, namely moving some assets from Lord Abbett, the short duration manager, to Delaware Diversified, the core plus manager within fixed income. Now, if we skip ahead to page 7, we'll just dig a little bit more deeply into the performance of some of the asset classes themselves and some of the managers at a very high level. We don't have much of the commentary yet, but you'll note up top that is the total trust returns that were on the earlier page, and then anytime you see another darker row, that is the respective asset classes. So composite is just a word synonymous with asset class. So in other words, the U.S. equity asset class, a weighted average of the underlying investments, was up just a shade under 6%, was about 30 basis points behind the benchmark there, mainly due to the active managers, which are the 3 lighter gray rows. So the first 2 Schwab funds are index funds. Then you have JP Morgan, the active manager in large growth, William Blair, small value, and John Hancock, small growth, all made money but lagged their respective benchmarks. So a little bit of underperformance from those managers driving the slight underperformance at the asset class as a whole. Again, don't have the commentary yet, but we'll share that with you at our next meeting in December. On the non-U.S. equity side, in the middle of the page there, you can see pretty much spot on its respective benchmark. Unlike within the U.S., we had half the managers, or 1 out of 2, outperformed their respective benchmarks. Namely, Dodge & Cox was a little under a percentage point ahead of its benchmark, whereas WCM, the 3rd lighter gray row there, was about 2 percentage points behind. But when we aggregate everything up, it left us pretty much in line with the benchmark. And then finally, emerging markets, you can see below, up 7.4%. Relative to the benchmark at 8.7. Like we discussed earlier, the vast majority of that was that fair value pricing issue. So we would expect that to reverse. So if you recall earlier today, it was about 1 percentage point. So this is a little more. That's mostly coming from Invesco, the manager we removed out earlier in the quarter and replaced with DFA. But again, that fair value pricing mechanism washes out over time. So we should expect a kicker in the other direction here in Q4. We want to go to page 8. Well, we'll really kind of skip over page 8. Page 8 is just a listing of the private market investments. Again, we'll give you an update on that shortly. And actually go to page 9, where the first half of that page is also private market investments. But then we get into the remaining asset classes. So infrastructure, you see there towards the middle of the page, IFM, a very strong quarter, up almost 4%. If you recall earlier this year, they had a difficult Q1. And the reason behind that was they had a decent ownership chunk of a publicly traded security, the Spanish utility. And what happened was the Spanish utility was essentially delisted from some of the indices out there because they usually have a rule on what's called free float, meaning that a certain percentage of the shares of a company have to be available for investors to trade. It's like a liquidity requirement. And between IFM and some other private owners, they kind of breached that level. So it's kind of an interesting dynamic where it was a listed company, it was kicked out of the indices. So in turn, that kind of decreases the demand for the equity, right? Passive investors no longer have to sell it active managers may not buy it because then it's an off-benchmark security, but nothing changed with the actual underlying fundamentals of the business. But its share price got hit because of that. But since then, it was taken private and basically was written back up because nothing was changed with the underlying fundamentals of the business. So it's kind of a wonky return pattern, if you will, but good to see IFM recouping some of that headwind we saw earlier in the year. And then finally, you can see the TIPS composite. That's just a passive investment, so in line with the benchmark as we would expect. And then within fixed income, about a 0.5 percentage point behind the benchmark. Again, we have two active funds there. You see Delaware Diversified Loomis, kind of, in aggregate, probably slightly ahead of the benchmark, but the key driver of the underperformance was really Lord Abbett below. Not necessarily that they were slightly behind their benchmark, but because they're a shorter duration manager, so less interest rate sensitivity. So in other words, in an environment where rates rise, it's helpful to have less interest rate sensitivity because that puts downward pressure on bond prices and vice versa. So if we look over an intermediate period, kind of in that darker fixed income composite row, 3-5 years, having shorter duration was pretty helpful. But in the quarter and really over the past year, that was a headwind as rates had come down, really in Q3 there. But as I mentioned earlier, rates dropped pretty notably in Q3, but have almost backed up or retraced 50% of that drop just in the 3 weeks here quarter to date. So with all that said, that wraps up my comments for the update. Again, we'll get a little bit more granular in December, but I'll pause there to see if there are any questions or comments that I can address before we move on. So with that said, if you want to jump to page 11 with the private markets update, remember these investments are generally reported on a lag. Think of it, the cadence as any quarter end that is not a calendar year end. Statements are typically released anywhere between 30 and 60 days afterward, and then a calendar year end, which are typically the fiscal years for these funds. Can be anywhere between 60 and 90 days. So it's on a lag in the performance reporting. So what we like to do is try to keep you as apprised as much as we can as the various statements come in on how the funds are kind of performing in aggregate here. So if you look all the way to the left, you'll see the asset classes listed from real estate, equity, and debt, and various footnotes of the data we have available, which is nearly everything outside of one real estate fund. And then the bottom row there is just the summation of the top 3 rows. But if you work your way from left to right, essentially what we're looking at here is the ending Q1 valuation, capital calls less distributions in Q2, the net investment change, and then the final Q2 valuation. So if you sum up those first 3 columns, you get to the last column. But the key data are really in the investment change column to give us a sense of the performance of the various investments. So if we start with real estate, you could see the investment change was down around $79,000 as a percentage of the beginning valuation. So that first column is about 13 basis points. Not terribly surprising given what we know, of what's going on in commercial real estate, and actually a little bit better than the broader commercial real estate markets that were kind of down maybe about 0.25% in Q2. So on an absolute basis, some depreciation, but on a relative basis, incrementally better than a lot of the real estate market out there. What's a huge gain, or what will be a huge gain when we see the restated numbers for Q2 in our next report, is really private equity, and this is the first time in a while we've seen this. So it's great to see as the markets sort of calm themselves down a bit. The investment change for private equity, you'd see north of $533,000. So as a percentage of the beginning valuation of about 19.4, that's about 2.75%. So a pretty big upward revision in Q2, and also about more than double what the underlying benchmark is. And the benchmark you typically use for private equity is really just a universe of private equity managers. So in other words, the managers here have been doing better than their competitors, at least in Q2, which is the first time in a while, not just from an absolute perspective, but a relative perspective as well. And then finally, for private debt, you can see that net investment change of about $22,000, just about 1% of the beginning valuation, as that allocation has been winding down more quickly than the others over time. It's about a percentage point, again, of that beginning valuation, but unlike private equity, the benchmark there was up around 2%. So when we think about sort of the relative performance, only 2 or 3 of these did better, But the biggest one, private equity, as you can see by the beginning valuation, did the best. So when we restate the Q2 numbers, not only will we get a decent absolute upward revision, but on a relative perspective should be helpful too. And that upward revision we can sort of triangulate when we look at the summation for private markets, the investment change of, we'll call it $475,000, about 1.7% of that beginning valuation. And these assets comprise a little bit more than 20% of the total pool, right? So 20% of 170 basis points, we'll call it 35 basis points of an upward revision that we'll get from the originally stated numbers, which is what we were used to prior to not prior to the pandemic, but almost prior to the economic reopening, right? Because since then, sort of M&A activity, the IPO market has dried up to some degree, and it's been more difficult sledding for these types of investments compared to public markets that have done quite well. So this Q2 is what, again, we were accustomed to historically prior to the last 2-3 year period, but, we'll certainly take it, and we'll restate the performance from Q2 and show you that information when we meet again in early December. So with that said, that wraps up my comments as far as the private markets update. But again, I'll pause here for any comments or questions. All right. So the next slide is essentially the impetus for the meat of our discussion here today, and will be somewhat deja vu all over again for those of you at our meeting yesterday. But I wanted to provide you an update on one of the fixed income managers, the Delaware Diversified Income Fund, and really focus on the verbiage on page 13. But before I get into the recent issue, just a little bit of background in that first bullet point. So the Macquarie Group, which is an Australian-based financial services firm, acquired Delaware Investments from Lincoln Financial in 2009, so about 15 years ago. In 2017, you can see in that second bullet point, Macquarie rebranded Delaware as Macquarie Asset Management, but the U.S. mutual funds continued to carry the Delaware name. That's why it's, even though there's a different parent, it's still called the Delaware Diversified Income Fund. They kept the naming of the mutual fund itself, even though there were organizational changes. Now, as far as why this is a discussion today, there's really the next subsequent bullets here. So recently, basically, I would say about a month ago, almost exactly, maybe 5 weeks, Macquarie announced they had settled an investigation by the SEC into a now defunct strategy, their absolute return MBS, standing for mortgage-backed securities strategy. And the issue is in that sub-bullet point, and I will just read it almost verbatim here and then explain exactly what we're talking about. But the SEC essentially stated that they fined Macquarie nearly $80 million to settle charges for overvaluing, we'll call it 5,000-ish, largely illiquid CMOs meaning collateralized mortgage obligations held in 20 advisory accounts for executing hundreds of cross trades that favored certain clients over others. What does that mean? So let's start with the idea of a cross trade itself. So typically, if you're managing assets, or even if you're managing your own money, when you sell a security, it's sold on your broker platform on an exchange, and you pay a cost for that, right? For very many investment managers, they run multiple strategies, and they have multiple strategies, and the securities they own may be relevant or appropriate for multiple strategies. So some firms will engage in what's called internal cross trades, where they will essentially use various funds and they will cross the assets, right? Maybe some assets here are relevant in fund X for fund Y, and some assets in Y are relevant for X, and you cross it. Now, it's easy if there is an observable price for securities, right? If an equity trades, we know what it's worth. It's trading throughout the day, similar for fixed income securities. And I should back up. Why you would do that is because you don't then have to pay the cost, because you're not selling it on an exchange. You can just do it internal, and there's no cost. The problem arises when these are largely illiquid, as stated here, and don't trade. The values of those securities are highly subjective. Now, there should be procedures and controls in place on how to value those securities. It could be, say, a discounted cash flow approach, sort of a public comparable valuation. So you're saying, all right, we own this, it doesn't trade, but there's X, Y, and Z securities that have a little bit of securities, some observable prices. So we can use that as a comparable reference point or some combination of these measures. But essentially what happened here is the SEC found that whatever those procedures and controls and compliance procedures for Macquarie were either not followed or not they weren't followed to the degree they should have. And the SEC essentially said when they did the cross trade, somebody lost and somebody gained, which is a breach of fiduciary duty. Okay, so I want to be clear about the fund in a second, but basically the outcome here is you see in that whatever third main bullet point, without admitting or denying, which is usual language around this, Macquarie agreed to pay the penalty and retain a compliance consultant almost a year ago, even though the news didn't come out until recently, and they have to retain that engagement for a couple years. So when we think about the OPEB, did this affect the OPEB's investment? No. Is it a breach of fiduciary duty by one of the managers at a firm level? Yes. We think about the IPS, we usually do this by a watch list, where if there's any performance issue, team issue, et cetera, manager goes on the watch list, we monitor it very closely for 6 to 9 months, and at the end of that period, we make a recommendation for the board's consideration to either take it off the watch list and continue or replace it like we did with Invesco. Earlier this year, however, there's also language that states the board, at its discretion at any time, can terminate a manager for any reason. And in our opinion, this would, at a minimum, warrant an immediate review of potential replacement options, which is what we have in the subsequent pages. But with all that said, I will pause there for any comments or questions around this specific as it relates to the Delaware Fund.
So this did not affect us
No.
in any way?
If we otherwise like them, how does the problem, since you have this mismatch of knowing what the pricing is, how does that ever go away?
Since you have the mismatch, well, I think it's not relevant for this fund, right? Because these securities are not in a fund like this, but the problem itself is hard to solve, right? But it's the way the controls and the procedures that you have in place that should be verified by whatever compliance person you're using, right? Or department, whether internal or external, saying, this is how we're going to value this stuff. Mm-hmm. And we're considering doing these trades. And if you're following a pre-approved process, then it shouldn't be an issue, right? And we don't know the specifics, and I don't want to assume exactly what happened, but when you're fined that amount of money, you were clearly not following those procedures that should have been in place, or maybe were in place and not followed to a T.
So the procedures themselves may not have been perfect, but as long as you were following them, you probably weren't transgressing.
You can make that argument.
Okay.
Yeah, because the perfect
Because the problem doesn't go away.
No, it doesn't go away, because if you do this with the liquid securities, you don't have an observable price. But like anything, you need to have policy, procedures, and controls in place that your compliance team is going to sign off on, whether they're internal or external, right? So what this tells us is that those procedures, policies and controls necessarily weren't followed, and you can't favor somebody over another. That's the heart of the matter.
And since we were never notified that we got too much or too little in doing all this, we were not an affected party.
Yeah, that's correct. So these types of securities would never have been in this strategy in the first place. Right. And who knows where the $80 million goes? I don't know. It's not. Any other comments or questions?
Well, I'll just make the observation.
Yes.
In my opinion, even the appearance, whether it was intentional or not, of misconduct, or at the very least not following established protocols and being compliant, renders them ineligible to continue in the participation.
I would agree with that because, it's the appearance.
Mm-hmm.
So you probably have a convoluted, best to read it off the page recommendation for this?
I don't know that I take kindly to the description.
I'll withdraw the word convoluted then.
With the prescription would begin on page 15. I would call it a detailed prescription.
I agree to that.
So with that said, the exercise here beginning on page 15 and following for 7-8 pages or so is really a comparison and a contrast of options for the board to consider, and we will compare and contrast these options with the current fund from a performance perspective, just so you can see the historical record here shortly. So again, before I jump into this matrix and we start breaking things down, just want to remind the board of the current makeup, right? So Delaware, another investment, Loomis Sales, they are both what's called Core Plus managers. So Core means investment grade, Plus means they have the ability to invest in sub-investment grade debt. So high yield bonds, emerging market debt, et cetera, et cetera. And then the third manager, Lord Abbett, is just like an straight investment grade manager, but on the shorter end of the maturity spectrum. So I'm going to circle back to that later on. So putting it forth, essentially three managers before options for the board to consider. So the first two options are both run by Baird, and again, we'll discuss the relative differences as we work through the pages. But the first one, the Baird Aggregate Bond Fund, that is a straight investment grade manager. So that's more considered a core fund, no plus. So they're all investment grade, no sub-investment grade. Whereas their second strategy is core plus, although we would consider it core plus light in the sense that they can add some sub-investment grade, but typically limited to 5% of the fund, whereas a lot of these core plus managers can go up to 15 to 20% in those types of securities, which is exactly what Reams does at times. You can see the Carillion Reams Core Plus Bond Fund. Reams is the investment manager sub-advising that fund, and I'll talk more about the limits on their risk management to those sectors in a minute. But then the final option is just a straight index, the Fidelity U.S. Bond Index Fund. So it's just going to track the broad investment grade universe. And when we get towards the end and think about risk and think about the OPEB as a whole, we'll talk about why that's an option as well. But as far as the matrix itself, I won't cover everything here, really just talk about the key differences so we can start to break things down. But I did want to mention for the strategy inception, everything goes back multiple decades, so it does meet the investment policy requirements that require a strategy to have been in place for a minimum of 7 years. The other key differences, when you look at the next two rows there, Baird tends to manage a little bit more money than Reams there. The U.S. bond index is the biggest strategy. That's not really surprising and or relevant because they're just trying to match the broad investment grade market. But I would note in the number of holdings, Baird is certainly much more diversified, even though they have a lot more in assets under management. Certainly more diversified with those assets across their individual holdings, whereas Reams is a little bit more concentrated. Now, what's interesting, and we'll flesh this out as we continue here, when you look at that yield to worst, and typically you hear yield to maturity, but yield to worst means that if you hold some bonds that technically are callable prior to the maturity date, so this takes into account what the yield would be if they're called, which is kind of your worst case scenario as an investor. Okay, so that's why the nomenclature is a little different than what you would typically hear as yield to maturity. But the first two rows make sense, right? So a straight investment grade manager as Baird has a lower yield than Baird Core Plus because they have a little bit in sub-investment grade. Those bonds have a higher yield because they carry more risk. What's interesting when you look at the Reams portfolios, even though, as we'll see here shortly, they have the ability to add much more in sub-investment grade debt, they are pretty reactive to valuations in the market. So you can see they're actually running a pretty conservative portfolio at just 5.1% right now. They're very defensively positioned because they're just not finding value in those areas. And I'll talk more about that later on. And then the bond index itself, not surprising, it has the lowest yield to maturity. As we'll see here in a minute, it has the most treasuries, which typically carried a lower yield than things like corporate bonds and mortgage-backed securities. As far as the quality, they're all pretty much in line with each other. Baird Core Plus, slightly lower given the high yield exposure. And then the other one, the effective duration, everything's pretty much in line except the Reams. They are a little bit longer duration, and I'll talk more about that later on. The last thing I did want to note is you look at the fees. Both Baird funds are very attractive for active fixed income managers. And as far as the Reams one, I'm noting 50 basis
Considerably higher, yeah.
50 basis points, Commissioner. That said, when we had put together the materials, we only saw the I or institutional share class available on the principal platform. So I worked with Christina Myers, who's our on the county's contact, who's phenomenal. And she got back to me and said that there's an R6 share class. And I said, I don't see it.
That down here at the
Yeah,
bottom
I
there.
don't see it. Is it available? And she got back to me yesterday that it is. So ignore the 50. 40, which is still a little
higher, yeah,
higher
yeah.
than Baird, but in line with the Delaware one right now, and probably in line with the average that you see across the marketplace. But yeah, the 40 is relevant. The 50 is not relevant. So with that said, let's dig a little deeper into the three managers, and then we'll really talk about the relative sort of differences across exposures, returns, and all of the key statistics. But start with Baird on 16, and probably not surprising given the assets under management they have. It's managed by a very large team, very stable team with a handful of people who have worked together for more than 30 years. So even predating the inception of those two funds. So they're probably one of the most well-known, stable fixed income organizations in the universe itself. And as far as the process, how they're different, number one, you can see they maintain a neutral duration. So they don't take interest rate bets. Okay, interest rates are notoriously hard to predict, and they're saying we don't have an edge there. We're going to focus on what we do know, and according to them, that's security selection. So when they're looking at securities, you can see in that second bullet point under the process, they're looking at the securities themselves, the sector allocation relative to the benchmark, which we'll look at, and yield curve positioning. So even though their duration or interest rate sensitivity will be in line with the benchmark across the yield curve. So at various maturities, they may overweight something, maybe on the 5-year part of the curve, underweight the 7, because they see relative value there. But in aggregate, the interest rate sensitivity will be in line with the benchmark itself. And as far as the security selection in the third bullet point, they're looking at pretty straightforward things, the relative value across issuers, credit quality, duration characteristics, fairly straightforward. And the key difference here, so for the Core Plus strategy, the sub-investment grade exposure is typically limited to 5%. Again, we kind of call them Core Plus Light because that's well below the cap that we see a lot elsewhere, including Delaware and Reams, as we'll see in a minute. And then from a risk perspective, like I said, they're duration neutral, so not taking rate bets. And then the second one's a little bit of a differentiator in that their credit positioning is generally on the shorter part of the yield curve. So we would argue that's a more conservative approach. When things go bad and spreads widening, putting downward pressure on corporate bonds or lower rated bonds, they typically widen more for longer term maturities because it's longer time for the bonds to mature and you to get your money back. So if you're taking that incremental risk on the shorter end, you're going to get that money back sooner. So when things go wrong, the spreads for those bonds tend to be much more behaved than, say, a 7, 8, 9, 10-year bond where you have an extra 5, 6, 7 years to maturity compared to the short end of the curve. So again, I would consider that a more conservative approach to many out there. And then finally, you can see that typically limit any non-government issuer to 5% of the portfolio, which is fairly standard. Now, if we look at Reams on 17, just try to draw out some of the differences, of which there are a few here. The team, much like Baird, pretty stable, not more mid-sized. Again, not surprising given the AUM I showed earlier, but the investment team is led by 3 people, the CIO and 2 key PMs. And they're supported by 12 professionals that are kind of segmented across different buckets. So one being credit, another being securitized, so think mortgage-backed securities, and then the third one's more relevant for global and international bond portfolios on rates and currencies. But again, been working together for a very, very long time. Now, how their process is different is really in the first half of that first bullet under investment processes. They do top-down decision-making. So when you talk about Baird, that's security selection, that just means bottom up, right? So you're looking at the securities themselves. Top down means that you're taking into account macroeconomic conditions. What's the economy doing and how may that influence your duration or interest rate sensitivity decision? How may it influence where you allocate across sectors, things of that nature? But they're also complementing that with the same bottom-up security selection, because at the end of the day, securities are going to make up the portfolio, but they will make tilts, whether it be interest rate sensitivity, sector allocations based on their top-down or macroeconomic outlook. You can see the steps in that process. So the duration decision is first. I'll talk more about that in a second. And then they do sector exposures, both on a top-down basis, as I talked a second ago, and then a bottom-up basis, meaning that, say, they're neutral on a sector from a top-down perspective, but they're finding more value there on the individual securities, then that means they might overweight the sector just based on the relative value of the underlying issuers. And then the third step in there, you can see the individual security selection. From a risk perspective, this is really try to draw out the relative contrast. So portfolios, they will make rate bets, duration range of plus or minus 30%. So if the market right now is about 6 years, that means they can go down to 4.2, up to 7.8. Generally don't go that far. They were at 6.7, so basically that's a 10% overweight on duration, which means rates fall. That will benefit them more than the benchmark and vice versa. And then a minimum of 80% of the portfolio must be investment grade. So we think about it as an accounting identity. Obviously, they have a cap of 20% on sub-investment grade, which again is more consistent with their peer group. Again, Baird's more of the outlier there, being more conservative. And then much like Baird, you can see that outside of the government issuers, issuer limits are capped at 5%. So if you look at 18, we'll run through this quickly because Fidelity is just the index fund here, but you can see the team, we have 3 PMs, traders located alongside the PMs. That's incredibly important when you're trying to manage an index fund, to have your traders work in unison, right? Because obviously you're trying to mimic the benchmark, but you have to deal with issues like flows coming in and out, transaction costs, things like that become incredibly important to be able to match the benchmark as closely as you can. As far as the process, again, they're just trying to match the Bloomberg US Aggregate Bond Index. That's the benchmark for the managers we're talking about today. It's the benchmark we're using, the IPS, for fixed income. But given the large number of securities in the benchmark, which is, I think, somewhere around 12 to 15,000, they use what's called an optimization approach. So they don't own every single security in the benchmark because it would just be too costly to do so. Instead, they try to minimize it by just matching the key risk exposures, right? The sector allocations, the duration, the yield curve positioning, credit quality, things like that. Because if you held those extra 3, 4, or 5,000 securities, then the transaction costs would cause you to deviate from the benchmark pretty dramatically. And in fixed income, unlike equities, the dispersion around similar securities is relatively minimal, right? So you can have 2 consumer discretionary stocks and move in like completely opposite directions, whereas in fixed income land, they generally behave relatively similarly, particularly when the investment grade world, where you're not worried about things like defaults like you would in high yield. And then risk management, they don't hold any out of benchmark securities, and they do have some risk tools in that bottom bullet point to monitor ex-ante tracking errors. So that ex-ante just before the fact. So try to predict what that tracking error, the differences in returns from the fund to the benchmark are going to be moving forward. So with that said, if we want to jump to 19, we can really draw out some of the key differences here, which will be helpful context for when we get to the performance. And just from a sector perspective, in the investment grade world, you have the 3 sectors you can see on the X or horizontal axis. So you have the government issuers, corporate credit, and then securitized, mostly mortgage-backed securities. And if you look to the left there, and all the colored bars are labeled in the legend at the bottom of the chart, all 3 active managers underweight treasuries. This is common. This is sort of a structural thing for active fixed income managers, because if you ignore for a second sort of any duration decision and things like that, how do you beat the benchmark? You out yield it, right? Net of your fees. And in order to out yield it, you have to underweight treasuries and overweight the other areas, because the other areas have additional yield given they have some inherent credit risk. So when you look at the credit, you can see Baird's overweight there. And then securitized, that's where Reams is overweight more than Baird itself. But what's interesting, if you look all the way to the right, you see that sub-IG or below investment grade. Baird Core Plus, again, typically limits to 5. They're about half that right now, but you don't see anything for Reams. So even though they have the ability to go up to 20%, they are not afraid to run a very conservative portfolio when they feel they're not being compensated to do so. So recall that yield to worst I showed earlier. Again, these guys could be the most aggressive in here, but they have the lowest yield right now because they're saying we're not being compensated in the corporate bond market, in the high yield bar market. The spreads are very, very tight. Now, in turn, what they'll do when things kind of quote unquote go wrong and those spreads widen out and the value becomes a little bit better and they feel they're compensated, then they'll layer into it over time. And we'll see that impact in the returns here shortly. But it's, again, more of a more drawn out explanation because this is a snapshot in time. And if you took this at face value, you think, wow, Reams is very, very conservative, but they actually have the most flexibility of any of them. It just so happens right now based on the environment, particularly valuations among corporate bonds and high yield bonds. They feel like they're not being sufficiently compensated to take the additional risk. And if you go to page 20, this is, I won't belabor this here, it's largely borne out here, right? If you are not taking a ton of risk, if you just focus on Reams in gray, you can see they have most in AAA of the actives, most in AA, most in single A, and they're very underrated triple B there, which is the lowest rung of investment grade. So in other words, you know, they're even more conservative than the one bear fund at this point that can't even invest in sub-investment grade debt, again, which is consistent with what I showed on the previous page, and then that yield to maturity as well earlier on in the characteristics page. So with that said, if you want to jump to 21, we'll start getting into the return and risk characteristics. And we're going back, you know, kind of 1, 3, 5, 10, 15 years now. We're tossing in Delaware into the mix. They're the first bar. You can see the legend to the left in the bottom table. And the table is probably easier to digest the data. You know, the bar charts are pretty and all, but it's hard to distinguish some of that. So if we focus on the 1 year for a second, you can see pretty much all the active managers outpaced the index. And I'd note Fidelity down, second up from the top. I'll just get this out of the way. As you work your way from left to right, you can see they've been spot on the benchmark on a net of fees basis across the board here. And I should note that from this page going forward, everything is net of fees that we're showing. So it takes into account the expense ratios I showed earlier. In that 1 year period, Delaware did do the best, followed by Baird Core Plus. Not surprising given that riskier bonds have done well over the past year. And Reams, as I mentioned, has been more defensively positioned. What's interesting, however, if you look at the 3 and 5 year period, that script or that narrative is kind of flipped on its head, where Reams has really done the best across both those periods. So really protecting in a poor bond environment over the past 3 years, particularly in 2022 when rates had shot up. But the 5 year number is really illustrative of what they did from a spread perspective based on the environment. So what happened was during March of 2020, when everything was being shut down, corporate bonds, high yield bonds, the spreads or the additional yield over safe treasury bonds blew out, right? So what they did essentially layered into those allocations because they said, all right, well, now we're being compensated. But then 3, 4, 5 weeks later, what happened? Economy reopened, huge policy stimulus measures. The Fed essentially said they were going to back the corporate bond market, and then the spreads just snapped back quickly. So that was very helpful for them over that period. Now, in a more normal type of poor environment, if you will, spreads like that typically begin to increase and increase. They are mean reverting over time, so it does pay to add exposure when they're cheap because you usually reap the benefits when they mean revert to their historical averages. But that short of a snapback that we saw in COVID is a little bit of an aberration. It typically happens over probably a period more like, you know, a year or even longer. But it just so happened that given their process, it led them to add exposure there, and it paid off relatively quickly. And then if you go to the 10 and 15 year period, I think the cadence of returns makes a lot of sense, right? You see Baird Core Plus, Reams Core Plus, kind of the top performers, although they flip-flop in those 2 periods, followed by Delaware, and then followed by Baird Aggregate because they don't allocate outside the sub-investment grade debt, but are comfortably ahead of the Bloomberg Aggregate Index. And if you want to go to the next page, we'll start digging into a little bit from a risk perspective. So on 22, what we're showing are risk-adjusted return called information ratios. And it's a little bit technical, but how I can explain it is in each of these respective 5, 7, 10-year periods that you see in the table, Basically, the calculation is how much did the managers outperform the respective benchmark over those periods, divided by how different their returns looked from the benchmark over those periods. So that's a measure called tracking error. And what it's essentially trying to measure, tracking error in a vacuum, is, kind of, are they making big bets or not, right? If your returns over time are swinging wildly relative to the benchmark, then you're making big bets. If the returns, are more mimic the benchmark, or just slightly deviate, then you're not making a ton of bets. So if you have a low tracking error, not making a ton of bets, then the denominator in that calculation is low. And if you can outperform, that makes the total number high, right? If you divide a number with a smaller number, the overall answer is higher, right? So think of it as if you have lower tracking error, but you can consistently outperform. It's a high information ratio. It's generally thought of as a manager skill, right? If we don't have to make a ton of bets, but we can consistently outperform by a decent amount, then we must know what we're doing, right? So you can see across all these periods, Reams, the 5 and 7 year numbers really strong, really due to what I spoke to about a minute ago in 2020 and COVID. And then over the 10-year numbers, they're pretty consistent across the 3 new options here, and Delaware kind of bringing up the year. So from a risk-adjusted perspective, over the longer term, not much difference. 5, 7 years, again, Reams benefiting pretty dramatically from what happened during COVID and how they layered in and were rewarded pretty quickly. On page 23, and as always, when we finish running through these, we'll sum up everything in a more digestible matrix. But last 10 years, we also want to think about risk here a little bit. So the first row there, annualized standard deviation volatility. What you can see as you work away from left to right, the managers that invest more in sub-investment grade debt typically have more volatility, because when those parts of the market come under pressure, they tend to be more volatile. So the cadence, if you will, makes a lot of sense in that Baird and Baird Core Plus are lower than the 2 other active managers. And then Fidelity is actually the lowest because it has the most safe treasury bonds, because it's trying to mimic the index. And then the max drawdown itself. So this is kind of the maximum peak to trough decline, which is, we're essentially looking at 2022 here, when interest rates rose rapidly, putting downward pressure on bond prices. Kind of the cadence is, Baird Core Plus and the Fidelity U.S. Bond Index, kind of the first and second, and then the others kind of make sense, right? Again, if you have more in those high yield bonds, you're going to experience more of a drawdown. And Reams, again, on sort of the bringing up the rear here, because they layered in. So when you think about it, given their process, they're going to layer in, and it's not going to work for a while, but then they get the snapback. So I think it's, lower lows, higher highs have led them to, being the first or second best performer over the intermediate long term. But if there's a poor environment, they're probably going to underperform because they're laying into that risk, because they know eventually it's going to come back, but they're never going to get the timing right. And then this last metric, this is when we're going to start thinking about this from a total portfolio perspective. So at the end of the day, we want the fixed income to be, sort of the insurance in the portfolio, right? So in times of equity stress, we know we have a lot of liquidity needs. We don't want to have to sell equities to meet those needs. Hopefully, if equities are not doing well, fixed income is, and then we kind of reach into that bucket, cash in that insurance, use it for that liquidity we need, or in a perfect world, rebalance back into equities when they become cheap. So you can think of that metric like equity beta as more like sensitivity to equity markets. So the higher the number is, the more they're going to trade like equities, and vice versa. When we want, from a diversification perspective, we want them not to trade like equities, right? We want them to be complementary. So again, not surprising, if you look all the way to the right there, the bond index itself has the lowest amount, because when you go out the risk curve in corporate bonds and high yield bonds, they increasingly trade like equities over time. And then the Baird aggregate fund that ignores sub-investment grade second, and then Baird Core Plus, Reams kind of a little bit higher, and then Delaware the highest, meaning that, over time it had the most sensitivity to equity markets, so kind of the least complementary. 24, and then we'll wrap up. So it'll be interesting to take a look at recent market declines, equity declines, and how these funds have performed. So we have 3 for your review here, starting with the Euro crisis back in 2011, followed by COVID, followed by the inflation shock of just 2 years ago. So if you look at all of these periods, it does make sense in that everything outside of COVID, if you go to the last row at the bottom, the Fidelity Bond Index did the best. Why? It's the highest quality, right? And again, the riskier you go out on the risk spectrum, those bonds tend to get hit or maybe don't appreciate as much as treasury bonds in times of stress. So that did the best across most periods. As I mentioned, Reams did the best in COVID. Why? Because those spreads widen, they snap back almost within a matter of a few weeks. So that's a little abnormal in the sense, not in the sense that they came back in, but just how quickly it was. But that's what happened, and that's how they did quite well. So if you look all the way to the averages to the right there, you can see Delaware kind of bringing up the rear, followed by the Baird Core Plus Bond Fund, Baird Core, and then Reams. Again, that's probably largely influenced by that COVID number. In more of like, say, an equilibrium bad environment, the expectation would be that Fidelity would do the best, probably followed by Baird Aggregate, Baird Core, and Carillion probably in line, and then Delaware bringing up the rear as it has. So with all that said on 25 here, as we try to summarize everything, and then I'll make a couple other quick comments about, putting the pieces together from a portfolio perspective. On the pros con for Baird Aggregate, solid returns, least expensive, that lowest equity beta. So right, again, lowest sensitivity to equities among the active options. On the con side, and admittedly, I'm nitpicking here a little bit, high AUM. We've talked about this for equities in the past. At some point, if you have a ton of assets under management, it can compromise the integrity of what you're trying to do. It's less of a concern in fixed income. I made the comment yesterday, there's a lot of debt out there, particularly coming from the federal government. So the U.S. debt markets are trillions and trillions and trillions of dollars. So it's not really a concern, but, I hate to leave the column blank. So I'm nitpicking a little bit to be frank with the board. On Baird Core Plus, again, strong long-term returns, risk-adjusted, lower fee. On the con side, did have the worst performance amid recent equity declines. For the Reams Fund, again, strong long-term returns. They had the best average performance amid recent equity declines. Again, largely influenced from what happened from COVID. Is the most expensive option and did have that largest drawdown. And then finally for Fidelity, right? Least expensive, lowest volatility, lowest equity sensitivity, worst long-term returns because most active managers tend to outperform because they out-yield the benchmark. Now to wrap up here quickly, again, we do all this kind of in a vacuum, right? But let's think about the OPEB as a whole for a second. So we have a low assumed rate of return of 6.5. Okay, so would argue take less risk. We have a lot of liquidity needs, right? Reimbursement of the county is probably about 4.5, 5% of the principal, argue, take less risk. We also, of the current fixed income, we have, again, the 2 Core Plus managers right now, plus Lord Abbett. So within the fixed income we have, which is not much given all the private market exposure, it's a little riskier in and of itself. So as I mentioned yesterday, not necessarily trying to influence the jury. Maybe I am. I know Mr. Walters probably thinks I am, but I would take that into consideration because it's important to look at these and compare them and contrast the relative merits, but then how does it fit in the puzzle overall, given the characteristics of the fund, right? Where the assumed rate of return is not high, we have massive liquidity needs, and the fixed income we have right now with the Loomis Fund is already giving us a decent core plus exposure. So with all that said, I will pause there. Happy to answer questions or address comments.
So Baird has the strongest long-term returns out of all.
Over the 15-year period, the Baird Core Plus had the best return. It was incrementally ahead of the Reams Fund. Okay. That was back on, I think it's 21, Commissioner.
Kind of got lost in the weeds here on some of this. So.
No, it was a lot of information. And
When you were talking before, I believe it was on page 17, you had mentioned something that you felt Reams was best suited or would probably perform the best as interest rates come down.
Right. So that was that's in the risk management Mr. Yingling, so you can see the duration generally has a range of plus or minus 30%, but my comment was really based on page 15. When you look at their current effective duration, it's higher than everything else. So that means they have the most interest rate sensitivity. So think about, and I'm oversimplifying this, but as you look at those numbers from left to right, that's kind of in the 5.9 to 6.7 range. What that's effectively saying is that if we have an interest rate change of a 1 percentage point parallel across the yield curve, so we're making assumptions that never actually happened, that the bond prices in these respective portfolios would be impacted by that from a percentage perspective. So if we look at Baird aggregate, if yields fell by 1 percentage points in a parallel way across the curve, the bond prices in their portfolio would go up by 6.1%, and vice versa. Yields go up by 1 percentage point, bond prices will go down by 6.1%. So Reams right now at 6.7. If rates came down, that would benefit them more than anyone else because they have the most interest rate sensitivity. But on the flip side, if rates go up, then they would get hurt the worst.
But looking at what you hear from the Fed and looking at interest rates, I haven't heard any chatter of trying to push interest rates up.
Well, the Fed, and I hate to use the word control, the Fed is, I'll use it, controls very short-term interest rates. Longer-term rates, you can make a pretty good case. I don't want to say it doesn't matter what the Fed does, but just to give you a quick example here, the Fed cut short-term rates by 50 basis points about a month ago. Since then, the 2-year note yield is up by 50 basis points. The 10-year note yield is up by 50 basis points. So the Fed handles the short end, but the further you go out on the curve, they're going to do what they're going to do. And in that sense, they've risen quite dramatically more recently. And when you think about the bonds in these types of portfolios, the average maturity is somewhere around 8 years. So there's, much more longer dated issues that kind of march to the beat of their own drum than necessarily what the Fed's going to do. I mean, even mortgage rates are up, notably, since the Fed cut short-term rates.
Okay, thank you. That's helpful.
Sure.
Well, I got to say that I'm leaning toward Ream.
Okay. I would concur with that.
I'm leaning more towards Baird.
Baird aggregate or Baird core plus?
I would do, I'm leaning towards Baird aggregate. Reams to me, I mean, yes, it's the most expensive, and that's,
Well, it's only marginally more expensive, but if you look on page 22, it looks to me across 3 different time columns, you get your money's worth.
And all those numbers are net of fees, correct?
Yeah, every number based on a return in here is net of fees. Yes, sir.
I'm not sure that I would personally worry too much about being in what looks like second place over 10 years. We probably won't have this thing 10 years out. There'll be something else we want to do. But looking at the short term, they're pretty strong performers.
Well, let's hope it's there 10 years later.
Of course, all of this is looking in a rearview mirror. We have
Correct.
no idea where anything's going.
Right.
But
Yes, sir.
test me on this.
Yep.
If I was to go out and buy a bond, and then we have an interest rate change compared to what I have in my bond, the market value of my bond is going to fluctuate.
Correct. If you wanted to resell it, it would impact the price you got. I know where you're right. But if you don't sell it, it doesn't matter, right?
Exactly.
It's just a mark to market.
So Would it be typical for an investor to say, holy cow, I've lost X percentage on my bond holding, and forget that got into it in the first place for the income, not for the price? The price is irrelevant unless you sell.
Right, unless you sell, of course. Now, it depends on other actions that you take as well, not just the bonds in isolation. Per the duration comments, right? If you get that wrong, and then you take it off the table, you haven't really sold any bond, because not most, but a lot of managers will manage the duration just through Treasury futures, right? Because it's very easy to do that. Or a lot of them do it through the cash bonds as well. But if you're going to manage the duration, then you're going to have to execute some sort of transaction to dial it up or dial it down. So even though you're not selling any individual security per se, you're going to realize gains or losses just by changing the interest rate sensitivity too, for sure. But 100%, you're correct. If you have a portfolio, that those yield to worse I showed on the previous page, 5 to 5.4, whatever it was, the average maturities over these portfolios was about 7-8 years. So what's your return going to be over 7-8 years? It's going to be 5 to 5.4% if you held the bonds that whole time. Now, if you change and dial exposure in and out and this and that and spreads widen and this and would make all these changes, and the path to get there is going to be, more or less volatile depending on what you do. But at the end of the day, if you buy a bond and you hold it to maturity, it's pretty easy to calculate what your return is going to be.
Yeah.
Yeah.
So you also have to then ignore, if you bought one that's a little more volatile, you have to ignore that because volatility eventually goes away.
Yeah. So the volatility, right? So if you're
Amps down.
Yeah, exactly. The dam's down. Now at the same time, again, we'll think about it in isolation, but also for the total fund, right? So if we think about if there's some sort of drawdown period, and we try to hold, 2 to 3 quarters worth of the cash that we're going to need. So if everything in the trust went down, we wouldn't have to sell anything. But if you have sort of a more protracted equity environment that is not good, at some point you're probably going to have to reach into the fixed income securities at that point. You just hope that they've posted some absolute gains, and then depending on the relative performance of these funds, some may have incrementally outperformed others, but the deltas probably wouldn't. Deltas meaning differences probably aren't too great that would make a material impact.
So would the Baird aggregate
Yes, sir.
would perform the best if inflation continues to increase and interest rates go up? We would be safest with them.
If inflation goes up and interest rates increase, ignoring any other sort of changes, you'd probably argue that from an interest rate perspective, the Baird Core Plus would do the best because it has the lowest interest rate sensitivity.
Okay.
Now, in that environment, depending on what spreads do, right, if they also widen, then you could say, well, is that lower rate sensitivity going to offset that spread widening? Because then you could probably say, well, the bond index would probably do the best because it just has incrementally higher interest rate sensitivity, but it's the highest quality too.
Because my concern is, again, what's going to happen after 11.5, right?
11.5. Now, to that point, remember, again, this is a part of the puzzle, and we do have the 2 current managers plus Lord Abbott, which has a duration of like 2, right? So when we put the fixed income pieces together, the overall duration is not, it's probably closer to 5 within the fixed income. That's why in the Q2 return I showed,
Right.
it was about a 0.5 percentage point behind because we didn't get the kicker from rates falling. But over the past 3 years, there wasn't a kicker, whatever the opposite of kicker is. We took it on the chin, right, from fixed income, but fixed income in the portfolio did much better because of the shorter interest rate sensitivity. So, regardless of whomever selected here, we're going to have less interest rate sensitivity remaining in the current fixed income because of that third part of the
Right.
puzzle we have with Lord Abbott.
Would we be well advised, given the election is right on us, and we don't know who the presidential selectee is going to be, but more importantly, we don't know how Congress is going to look, okay? Would we be well advised to postpone this thing to our December meeting?
What I would say is, based on why we're having this conversation, the best thing would to do if we want to consider longer is to move the money in the index fund now, which we could then revisit.
What would the cost of that be?
The cost
If
of
we
the
decided, my concern would be if we move it now
It
and then move it again, are we gonna,
the
Pay a
trading
penalty.
costs, I think, are $5 a trade.
okay,
Yeah. So
okay.
$5 on Julian's.
Yeah.
on what?
Julian's. Doesn't
Jillian's.
matter, it's still $5.
I'm not following.
Regardless of the size of the trade.
Regardless
Oh
of the
yes,
size
I'm
of the
sorry.
trade.
I'm sorry. Yes, yeah. It's 5. Yeah, so it's not based on lot size or anything like that.
So
So,
I just wanted to make sure we weren't gonna,
so it would be. So think about this, right? If we eventually, it would be an extra $10, right? Because if you bought this and then sold it, right?
if we bought it, if
Would it be
we, if
an
we
extra
move it,
$5, right?
if we move it into the Fidelity, just
Park it there.
park it there for
Yeah.
now, and then we moved it again when we meet in December, it's gonna cost us $10 total.
Right, it's 2 transactions.
2 transactions.
If I have the trading costs right, I it's no more than $10. I'll tell you that, but I think it's 5. But so yeah. So if you did it now, 1 transaction, and then if you moved it again, 2
I
transactions.
think he'll spot us the difference, but
I'm fair with that.
I have it. I'm good for it.
But here's the question, and what you started the explanation with. Why move it? That's the part you haven't elaborated on.
Well, I'm sorry. What I meant was the impetus why we're having this conversation in the first place. The issue with
Leaving Delaware.
Yeah.
All
Yeah.
right.
I'm sorry. I would.
I want to get that on the
I
record.
was. You're right. All right. I was implying that. Yeah. The reason why we're here in the first place with the issue of the SEC investigation, but if the board wants to further think about it, or I'm sorry, have additional information before making the decision, that would be my recommendation. I'd be pretty adamant about that.
I would agree with moving it out of Delaware.
Agreed.
Correct.
And I think we have 2 or 3 fairly safe options. I don't think that there's a bad option. I don't think you gave us a bad option.
I try not to.
I would like to know what Ms. Van Cleef thinks.
Thank you. I'm new to the table, so I do have a couple of clarifying questions, but a couple of thoughts as well. I suspect our strategy is a long-term strategy, so this conversation around the next few months, while it may impact us all, I think much of that is already baked into the market, that expectation of change. Correct me if I'm wrong.
I think right now, it's hard to say, right? People read things however we want to read things based on the biases, right? So it's hard to say. I know that's not a good answer, but
That's fine. And then my second question is, given that we are up in perpetuity, the strategy, which of these best aligns with our strategy? Because I think a longer-term view, I'm not a short-term gambler.
Me neither.
So, so I appreciate that conservative perspective. But given that we have a long-term strategy, which of these fits best with that?
over the very long term, I think the Reams or the Baird Core Plus are the best ones. Again, my only concern with those, and normally it would never bring the index option here, but it is the safest because they're always trying to think about the liquidity needs, right? So, and what's going to happen in times of stress. And nothing may happen, right? But we never want to find ourselves in a position where we have to even consider selling something to fund needs. And we have a lot of cash. We're carrying a lot of it. We continue to get money back from private markets, so I don't foresee that happening. But it's kind of my job to worry about that. But from a long-term perspective, to Mr. Walters' suggestion and Commissioner yours, I think either of those would be the best, given this fund operates in perpetuity. And the liquidity profile will likely change at some point too.
Right.
I think right now we're experiencing large draws on the fund, but they may come down a little bit as we go out in the future, because the county might find itself in a position where, or in a place where it has to start to contribute a little bit, depending on what happens with the underlying participants, what happens in markets, and things like that.
Well, the problem with trying to bake in what's going on the national political scene, and I wish I had this chart in front of me, but people have looked at it. If we have, I'll call them red-blue, a red president, then how does Congress stack up? Are both houses red? And then how does that look? Well, what if we have a red and both houses are blue? How does that look? How if they're split? How does that look? You could go insane trying to figure out. I mean, it's an interesting exercise historically, but going forward, it doesn't mean squat. So we're here today. We know what we want to move away from. I'm not inclined to skip it through something as a holding pattern, because I don't think we'll have any more clarity 5 or 6 months from now than we will today on our long-term strategy.
Right. Yeah, I think that's probably what you're getting at, Ms. Van Cleve, was that regardless of what happened, it doesn't necessarily impact the goals, objectives, and constraints of the fund itself.
No, it's only a 4-year bet anyway, right? I mean, think about it.
It's a 2-year bet when you get to congressional elections.
Well, or 2-year bet, yeah.
I feel like we live in a perpetual election cycle. I feel like it's a
right.
one-day bet these days.
So I wouldn't want to move it into a holding pattern. I want
agree.
to select an option. I'm not willing to, I'm not concerned about either of the two options that have been floated at the table. They each have, one will outperform the other by a margin, but I don't think it'll be significant. What stood out to me, I thought Reams had put themselves well in the short term, even though they have a lot of options to go into a lot of riskier options. They looked at reality of what is going on and positioned themselves diligently to deal with the realities of today. I thought that was useful. In the long term, they've performed extremely well. So for a long-term strategy, I find value in that. But I don't disagree that Baird is a good option, and I'm not pressed on either. But I would want to move it into a long-term solution, not a short-term solution based on short-term data.
I concur. I'm also comfortable with Reams. I don't anticipate we'll experience the kind of anomalous, I'll call it, experiences that we've had over the last few years, but I think they're well positioned. As you indicated, take into consideration the current prospects as well as the return and act accordingly.
Well, but even if we did, if we look back and we have another COVID, they came through that okay.
Yes, they did.
So are we done our discussion?
I think so.
Can we have a motion?
So if I may,
Yes,
Mr. Young, I
absolutely.
would say let's hold that thought, and we'll get to the recommendations,
Okay.
and then we can just make
Perfect.
one. Yesterday, Mr. Walters handed the motion. I'm sure he'd be fine with doing that again. So if we go to page, 27.
Time for a break, I think.
What's that? You can tell.
Did
Yeah.
we offend?
What's that? Jeff?
No. He'll be right back. I think we can push on.
Okay. So 27, just quickly. Before we get into the granularity of our balancing, so we'll just buy some time here for a quick second. The total assets of the trust you'll see up top, a little north of 125 million, about $125.2. Actually, unlike the LoSAP we talked about earlier, up about 350 grand because there's less in fixed income within the LoSAP, more in equities. So we've actually experienced an incremental gain there. And if you look all the way to the top right, that smaller chart again in that differences column, where we're showing green illustrative of an overweight to the respective asset classes and vice versa for red. You know, it's somewhat of an overweight to U.S. equities, but offset by developed non-U.S. and emerging markets. You see the private markets roughly in line. The only key difference here is we're a little underweight fixed income, largely because we have that overweight to cash, right? And when we think about the cash, we probably have enough right now to cover the next 3 quarters of claims, maybe, or close to it, hopefully. But I'll circle back to that in a minute. So if we look at the rebalancing in the middle column, the only recommendation given that asset allocation is towards the bottom there. So that would be a full liquidation of Delaware Diversified Income Fund and $9.3 million going into the new fixed income manager, where the difference there between the liquidation proceeds and the nice round number would come out of cash. And the reason we show money coming out of cash, we put this together like a week ago, and we don't know what the proceeds are going to be. They might be incrementally different based on the price of the fund when it's sold versus what it was when we put this together. So that's summarized on the next page. Very straightforward. $9.3 million to the new fixed income manager, full liquidation of the Delaware Diversified Income Fund. If those liquidation proceeds are short of the 9.3, then it will just automatically be pulled from the money market fund. There would be no additional transaction. It's just automatically pulled. So I think the motion would be essentially what's showed on page 28, but obviously naming the specific new manager.
There's no real damage then to our cash on hand.
That's correct. And I'm sorry, just quickly to your point, Mr. Walters, the cash on hand is around 3.6 million. I think the last, about 1.1 was the last one. 1.1. So if that's the run rate, we're good for 3 quarters. And remember, we have that Golub money that's going to come back March 1st, which is about 1.3. So we might be good for almost a year of need. So we're in a good spot from that angle as well. So with that said, I'll pause.
All right, I will entertain a motion if someone would like to make one.
All right, I'm going to give it a shot here. I move that we go for full liquidation of Delaware Diversified Income Fund. This is where I went off the rails. And move
9.3
the
million.
$9.3 million to Ream. And if we don't get 9.3 million in the liquidation, we will take the shortfall out of cash.
Okay, I think we have a motion. Is there a second?
I second.
Okay, any discussion?
Now, I do have a discussion point. What if we're long on
Then
the
the
proceeds?
residual will go into the money market fund.
All right, then it is going to go back the other way.
Yes, sir.
Okay. I have a first and a second. All those in favor?
Aye.
Aye.
Aye. Any opposed? Motion carries.
All right, great. Thank you for your attention and patience this morning. I know it was a long one, but important as
Perfect. Thank you very
stated.
much.
So thank you.
It's important stuff. We got to get it right.
Thank you.
All right, I think that concludes everything from Mr. Wing.
Yes, sir.
All right, so we're going to move on to the committee report from Joy Sapp.
All right, so since the last meeting, we've had one capital call and $58,000 with JMI Equity Fund. Administratively, we've paid out $11,015.30 to Boomershine and Principal for their various fees. The fiscal year 25 budget to reimburse is at $6.1 million. The first quarter reimbursement in August was $1.175 million. And the next meeting and the last meeting for 2024 is December 6th.
Fantastic. Thank you, Joy. Can I have a motion to accept the committee report?
So moved.
All those in
Second.
favor?
Second.
All those in favor?
Aye.
Opposed? And that carries. And finally, can I have a motion to adjourn?
May I ask a question first? Is Mr.
Absolutely.
Boomershine or one of his reps coming to this meeting next month, December?
Sure.
I can't remember. Do you remember whether Boomershine's coming next meeting, whether Catherine said? Catherine arranges those, so I'm not really,
Well, I thought I heard something
That
about
was,
that yesterday.
that was for the SORP.
Yeah,
The SORP. He was here in April. Did he do LoSAP or OPEB then?
did LoSAP.
Right, so they're on biennial valuations, meaning he'll be here essentially for these two we talked about today, he'll be here basically April every year and it'll flip.
One
So
of the
he did
others.
LoSAP in April, he'll do OPEB
next April.
next April, but for SORP,
SORP
he's coming
in December.
in December at whatever that was, that we're meeting
Okay.
on the 6th that's the Friday, so it would be the 5th, I guess. right?
Yeah, so I'm not on the SORP, the
Right.
plan administrator, but yeah, that sounds right.
Yeah.
Okay.
That's it.
And with that, did we have a first and a second to adjourn?
I'll make a motion to adjourn.
All right.
Second.
All right, we are officially, all those in favor?
Aye.
We're officially adjourned.